We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mike Beck, longtime investor in the resource space. Thanks for joining me today, Mike.
Tom, always a pleasure.
So the last time we had you on the show was quite a while ago, and you were saying that an instructive conversation might be to talk about a failure or two of yours when you got some of the macro factors wrong. So would you mind sharing with us your example of, let's say, lithium and what some of your biggest lessons learned from that time were?
Sure. So, we have, for lack of a better term, an investment methodology that we've sort of tried to stick to the last several decades, which is first and foremost to try to get the macro call correct and the supply-demand outlook. Because if you don't have strong conviction that the underlying metal price, whatever it may be, copper, uranium, lithium, is going up, it's just too hard because you can have the best deposit in the world, but nobody cares. And so that's sort of element number one. Element number two is we learned a long time ago that exploration risk is really tough. The probability of an exploration project becoming a mine is about 1 in 1,000. So it's a really tough casino. So if you can avoid exploration risk, you improve your chances of success by several orders of magnitude. So we try to first pick specific metals where we think the outlook for the next 2, 3, 4, 5 years is robust and that the price will go up. We then sort of search the globe for a qualifying asset, an asset that has already been largely de-risked because it was drilled sometime in the past and then maybe abandoned because the timing was in the wrong part of the price cycle, or it's in a difficult neighborhood like the Congo. And then, of course, entry price is sort of the third component. And often we get the first two right. We have the right metal call, we find an attractive asset, but we can't get an acceptable entry price. And a lot can go wrong. When the stars line up and you kind of get all three right, it's massive leverage on your investment. And maybe one of our best examples is Uranium. Stephen Detells and I in the mid-2000s got interested in uranium before it had really started to move, and the supply-demand outlook and analysis suggested uranium had nowhere to go but up. And then we found a very low-grade deposit, very large but low grade in sub-economic at the prevailing uranium price in Namibia. And we bought it for something on the order of $4 million. And then the uranium price went from $15 a pound to a high tick in July of 2007, 150. So it went up 10x. And the value of that deposit really went from $4 million to $2.5 billion. And so that's an example of where it goes right, which doesn't unfortunately happen all that often. It goes wrong more often. And maybe two most recent examples of where it didn't go right. Lithium. So we got interested in lithium and still are, for all the reasons your listeners are more than aware. And for us also size matters. So we went to Argentina and we became the largest holder of lithium brine resources. And at that time, lithium carbonate was maybe $5,000-$6,000 a ton. It ran up during the course of this exercise to $20,000 a ton. And we, like many others, thought it was going to keep going. And we got surprised because, in fact, what happened was the price came off, and it came off in a big and abrupt way and retraced. At the time, it's all the way back to where we started, which was sort of $5,000-$6,000 a ton. And so we ended up selling the company, and I think for $110 million in cash, but we got the call wrong. We didn't foresee lithium coming off as it did. And of course, now we kind of wish we maybe hadn't reacted by selling the company, because now lithium is strongly rebounding. And what happened was, in the case of lithium, the projections of near-term electric vehicle adoption were slower than anticipated. And as a consequence, the market went from being really super concerned about availability of lithium supply to a year later realizing that there was plenty of supply around because the EV adoption rate wasn't as fast as the consensus view. So that was an example of where we just got the macro call wrong. Another example is a private company that we have, which has a very large, one of the largest potash projects in the world. It's very advanced, and we've spent something on the order of $65 or $70 million and brought it all the way through definitive feasibility study. And we started it in 2011 and we still have it. And there we got interested in potash, unfortunately, too late in the price cycle. And after we acquired the project and started working on it in earnest, the potash price came off and has stayed down the last 7 or 8 years. And even though it's a fantastic sort of lowest decile world production costs, nobody cares. And so those are two sort of examples where, frankly, nobody has a crystal ball and our analysis was wrong and we paid the price. So when it works really well, this sort of investment strategy, but there are more times when something is going to happen. Either you get the price call wrong or you can't find a qualifying asset because, again, we don't like exploration risk. So those are some examples.
Mm-hmm. Excellent, Mike. Exactly as you were saying, you're an expert on the adoption of electric vehicles. So can you maybe share with us an update to your thoughts on the adoption curve of EVs and anything that has surprised you or that you have found of noteworthy change since the last time we saw you speak at the Jekyll Island conference?
Yeah, so the near-term adoption rate has been slightly behind consensus view, but I think actually increasingly the view is that this S-curve, this kind of classic S-curve adoption rate is going to accelerate. And I actually saw this morning a UBS report, which now has upped their, everybody has sort of their own adoption rate curve, but they've upped theirs. So they're now projecting that 25 to 30% of new passenger vehicle sales by 2030 will be electric vehicles. And that by 2035, it will be on the order of 50%. And that's kind of where I am too. So I think that the adoption rate is going to surprise everybody, at least the consensus view on the upside. And it's being driven not only by regulatory pressures, around the world, various jurisdictions have emission standards that vehicle manufacturers cannot meet unless they increasingly adopt electric vehicles as part of their sales mix. But more importantly, economics. So, I think the consensus view of when an electric car reaches cost parity with an ICE, an internal combustion engine, is all driven by battery cost. And when batteries are priced at $100 per kilowatt hour or less, it's game over, because at that point, the cost of owning and operating an electric vehicle is less than an internal combustion engine. And Tesla is at that point, and it is likely with the price, the year-on price performance improvements, that by 2025, that figure just across the industry is likely to be something like $70, $75 per kilowatt hour. And at that point, internal combustion engines aren't even close in terms of affordability or operating costs with electric vehicles. And at that point, every person that goes to buy a new vehicle by default will buy an electric vehicle, because why would you otherwise pay more for what's an obsolete technology that's being phased out? It just doesn't make any rational sense. So that's kind of what's driving it. And that's good news actually for the entire suite of battery metals, from starting with cobalt and lithium and nickel and graphite. And then maybe less talked about is sort of the impact on copper.
Mm-hmm. Mike, as we're talking about, new battery technologies, Gambit Energy Storage is building a 100 megawatt energy storage project in Angleton, Texas, to power up to 20,000 homes. So do you know of any appreciable demand coming from large scale battery storage like this?
I think, in fact, aside from electric vehicles, the other main demand driver for lithium ion and other battery storage chemistries will be the electric grid. Because as intermittent energy sources, renewable energy sources like wind and solar are increasingly installed, it becomes increasingly paramount that you marry those with storage on the grid. Because as everybody knows, the sun doesn't always shine and the wind doesn't always blow. And as those renewable sources become increasingly prominent in the energy generation mix, it becomes increasingly important to have battery storage. You know, it's all about, in the end, economics. And the most important driver in terms of determining the speed at which the battery revolution and the knock-on demand for battery metals will occur is the price of battery technology. And again, with Tesla at $100 a kilowatt hour, and the rest of the industry probably there in the next 1 or 2 years, and the entire industry at $70, $75 in 2025, I think the explosive demand by both the passenger vehicle industry, but almost as importantly by the electrical generation industry, is just going to surprise everybody, because increasingly you can't continue to increase the percentage generation of intermittent energy sources like wind and solar without increasingly introducing batteries as a critical component to ensure grid stability on the power grid.
So, Mike, would you mind updating us, if you can, on let's say the macro outlook for lithium right now? What are the the LME warehouse levels of lithium and the demand over the last year have been?
Yeah, so you're not seeing sort of eye-watering year-on-year demand, because lithium is used not just in battery chemistries, but also for a number of other industrial applications. But the latest estimate I saw of 2020 versus 2019 was sort of a 16% year-on-year increase in demand for lithium. And it's still, as you know, a relatively niche metal in terms of volume. You know, the entire lithium market is at the moment less than 300,000 tons, which may sound like a lot, but when you compare it to some other critical battery metals, it's not. So by comparison, for example, the nickel market is 2.5 million tons a year. So the nickel market, which is also a supercritical battery metal, is about 10 times the size of the lithium market by volume. And then if you go up the chain, you know, you can't build any of this stuff without copper. And the copper market is about 23 million tons a year. So it in turn is about 10 times the size of the nickel market and 100 times the size of the lithium market by volume. And luckily, lithium is geologically, it's not scarce. So the world's not particularly worried about running out of lithium. It does take a long time to bring, as with all metals projects, the lead time to bring on new production capacity is maybe the biggest single barrier to availability of new supply. So there may be some sort of lurches where there are some temporary shortfalls in supply, but I'm not worried with the passage of time about either the power storage or the electric vehicle rollout being hindered by lack of lithium.
Mm-hmm. But of course, part of that, let's say, equation, Mike, you need to be getting class 1 nickel, correct, for batteries like that instead of the more common class 2, correct?
You do. That is true, because the ferrous units in class 2 interfere with the electrolytic characteristics that you require for batteries. And I don't know if your listeners are aware, but there was a major announcement a couple of weeks ago by Tsingshan. Tsingshan is the largest stainless steel producer in the world. And all of its stainless steel comes from nickel pig iron, which is basically a class 2 nickel source. They announced, much to the somewhat surprise, and you saw a 20% downward correction in the nickel price immediately following their announcement, that they plan to deliver 100,000 tons of class 1 nickel by converting a portion of their existing NPI production in Indonesia to nickel mate and then to class 1 nickel sulfate, which is a class 1 product and suitable for battery use. So this announcement, which was kind of earth-shaking in the nickel world, is highly disruptive to everybody's sort of supply-demand outlook. Because even though this conversion process flow sheet from class 2 to class 1 has been known about and actually has been implemented on a small scale by Vale for a couple of niche products in Indonesia and in Caledonia in the past, it was never used on a larger scale, principally because it's more expensive as a class 1 nickel source. But what it does show is that once the nickel price reaches a certain critical level, then it incentivizes folks to put in the extra capital and operating costs to convert what is basically an unlimited supply of class 2, principally NPI, nickel pig iron, into class 1. And it changes what heretofore has been a sort of clear demarcation of or bifurcation of the nickel market between class 1 and class 2. So the market and the players are still kind of trying to digest this and update their models and figure out where this puts us in 2 to 3 years out, because that's been maybe that and availability of copper, but nickel in particular, because volumetrically it's much smaller market than copper, has been a concern of the battery cathode makers, because, to increase the energy density in these batteries, which is key to getting the higher performance and lower cost, the only way to do that is to insert additional nickel units in the battery chemistry. And the concern was always, is there going to be enough class 1 nickel? Because class 1 nickel is a lot harder to produce, but this announcement from Xinjiang is sort of been a game changer. And we'll just see. I think it'll be interesting to see how the nickel market readjusts and if other class 2 NPI producers, mostly out of Indonesia, also announce plans to introduce additional capital to convert some of their class 2 to class 1.
So does that take supply away from, let's say, the production of stainless steel, Mike?
It does, because, at the end of the day, it's nickel units. But the thing is that it's a lot easier to go from NPI. If you're stealing some nickel units from your class 2 NPI that's now going into stainless steel, it's not that hard then to replace those units with additional NPI production, particularly out of Indonesia, because there's a lot of this material around. And so the concern has always been on the class 1 side. There's plenty of NPI. So if you're stealing some NPI, you can easily, in the course with capital and 2 years of lead time, expand an existing NPI facility and replace those lost nickel units. Now, I think even though the nickel, it's been described by some, this announcement of 2 weeks ago, as nickel Armageddon, it's kind of bad news for the class 1 nickel guys like Vale and Norilsk, but it's kind of good news for the battery guys and ultimately the end users, being the electric vehicle manufacturers and the power storage folks that need batteries, and we're increasingly concerned about availability of class 1 nickel.
So, Mike, have some of the shortages that were projected in lithium or nickel 2 years ago changed in any dramatic way because of COVID, or has that equation only gotten worse because of the mine shutdowns?
Yeah, look, I don't think there have been any material shortages of either of those two metals. There may have been some temporary disruptions of supply, maybe more related to supply chain, not so much mine production. I think, for example, the uptick you've seen in both lithium and nickel prices over the last year is more a reflection of an increasingly bullish outlook for demand for those two metals going forward because of higher adoption rates in electric vehicles by consumers, and then also the increasing need to marry storage as you roll out more solar and wind power. So I think the uptick in prices haven't been so much driven by shortages, but more by, I think the demand for these two metals is going to outstrip consensus view. And so that means the price is probably going to go up, and let's get positioned maybe long with more units of both.
So your investment style is to identify the macro factors like a solid supply demand equation and then seek out specific investments that provide a leveraged exposure to that metal. So how do you apply that framework to, let's say, the nickel market in particular, Mike?
So it's not easy, huh? And often we fail. So in the case of nickel, and our interest in nickel goes back probably 4.5 years ago, and our thesis really hasn't changed. We still think that nickel is going to be a good place to be long and will outperform not only the general market, but the metals market as a whole. So with that thesis, we identified a company called Giga Metals. And I don't want this to sound like a stock promotion pitch because it's not. But since you asked the question, I think the easiest way to answer it is to give a specific example. So what is Giga? Giga is a TSXV listed company. It happens to own the world's second largest undeveloped nickel sulfide, which means class 1 nickel deposit in the world, which happens to be in British Columbia. It's called Turnagain. And so this really matches our sort of desired investment strategy. And at the time we made the investment, it still is. It was sort of an orphan overlooked because of, since the last peak of nickel, which I think was in 2007, nickel got to a high of $50,000 a ton and the stock was maybe $4. And then nickel prices collapsed and nobody cared. And the stock went to 5 cents, and that's kind of where we came in because we said, this is the specific metal we're interested in. There's no exploration risk because $50 or $60 million of drilling had been done. There was a PEA that had a rough estimate of the economics, and it was a extremely large deposit, being the second such largest undeveloped nickel sulfide deposits in the world. So in answer to your question, that's an example where how we executed on our investment thesis. We happened to get lucky and find a qualifying investment at the right price, massive size, low grade, but massive size. And as nickel price goes up, it should give you leveraged exposure to that underlying price move, the metal.
Interesting. So, Mike, how do you go about thinking about copper as well? You mentioned it earlier, and as we know, the battery metals will all need copper to transmit their power, A, through cable and B, through motors to the ground, right? So how do you see the copper market developing right now? And where do you see price going forward as we're, just flirting with the all-time high here?
Yeah, so copper is the largest of all base metals. It's about 23 million tons a year of demand. So to put that in context, it's about 10 times the size of the nickel market and about 100 times the size of the lithium market volumetrically. And electric vehicles and actually also grid storage represent a new and incremental source of demand for the metal. So it's not just the fact that an electric vehicle requires about 80 kilograms on average more copper than its internal combustion engine equivalent. But then you also, on top of that, for every electric vehicle that is sold, you need additional copper to build out the generation and grid infrastructure, and also just simple things like a supercharging station, right? So CRU, which your readers may not be familiar with, but they're a respected metals consultancy. Everybody has their numbers, but their numbers happen to agree with ours. They estimate that just electric vehicle related demand alone will represent about 4 million tons per year of incremental copper demand by 2030. 2030 is not that far away. It's 9 years away. And this is equivalent to 17% of current supply. Now, the big question is, where is this incremental supply going to come from? Because current copper mine supply is already, challenged by a variety of factors, including, declining grades, labor issues, permitting, getting a new copper mine permitted anywhere in the world is a lengthy, non-trivial experience. So, to get a new copper mine from the time you finish a feasibility study into production is typically 7 to 10 years. So we decide today, we want to go ahead and build this mine because we have a positive feasibility study. The earliest you're going to see first copper out of that project is probably 7 to 10 years away. So that's sort of a long way of saying that there are deficits baked into the supply chain because there's been very little incremental investment in new copper supply the last decade, principally because the copper price was relatively depressed until recently. And if you dig a little bit deeper, the average capital intensity of bringing on new supplies about, as we measure it in the industry, is about $10,000 per ton of annual capacity. So if you want to increase supply of 4 million tons, this is just to satisfy EV demand, which doesn't exist today, by 2030, you need $40 billion of incremental investment. So there are a number of compelling reasons why not just us, but I think most people in the space feel that copper is going higher. In fact, I saw today news that Trafigura is probably the largest copper metals trader in the world, but the head of their copper trading unit announced in an interview today, said in his view, he doesn't have a crystal ball, but he's pretty well plugged in, that he expects copper to go to $15,000 a ton. Today it's at $9,000 a ton. And there are good reasons why he can say that and not be crazy. I mean, on the demand side, demand is likely to outstrip supply for a couple of reasons. One, the stimulus programs that are being announced around the world, including now the US is talking about a massive new stimulus program for infrastructure. Mm-hmm. You know, all these infrastructure programs require massive amounts of copper. The greening of electricity, which we've talked about, means copper wins. The electric vehicle revolution means copper wins again. Substitution and mineralization really have plateaued. So we're not going to be able to continue to make stuff smaller. And the bigger it is, the more copper it needs proportionately. And so on the supply side, it's interesting too. And it's like a perfect storm. So there's been, as I mentioned earlier, there's been significant underspending the past decade on exploration and new mines. The current expansion CapEx is really too small to grow copper production much. It's getting harder and longer to get environmental regulations and permits. You look at the Resolution copper project in Arizona that BHP and Rio Tinto have sunk $1 billion in and been at it for 15 or 20 years. And is one of the largest, richest undeveloped copper deposits in the world, where their forestry exchange transaction, which was approved by an act of Congress, was just taken off the table by the Biden administration. So, and they've been trying to get that thing permitted for a decade. And then you add, just some simple geology, like unlike lithium, copper is geologically scarce. So, Mother Nature didn't give us a lot of it. So all of these factors, both on the demand pull side and on the ability to deliver incremental supply, in our mind at least, and I think in the minds of a lot of people that look at this stuff, it points to one thing, which is we're going to have a really robust copper price for the foreseeable future. Because again, these mines take 7 to 10 years to bring on. So I think if you're long copper, in whether it's the physical metal or you own, Freeport, or you own some of the, the smaller cap, higher risk things, a rising tide's going to lift all of these copper boats. And so that's our view. And that's been we've been really keen on copper the last 2 or 3 years for the reasons that I've just enumerated.
Mm-hmm. So, Mike, as the electrification of the world continues, the need for clean, cost-effective baseload power will become more important than ever. So in your opinion, does this bode well for uranium demand to grow over the coming years? And have you seen that catalyst that you feel is necessary for you to get back into looking at some exposure to uranium?
Yeah, that's a really interesting question. So, Detels and I were really active in uranium from 2005 until maybe 2010 or so. And it worked really well. And then it just became too hard and uranium price, got crushed, as often happens. And we've looked at a lot of uranium sort of assets since then, but never really pulled the trigger simply because we weren't convinced in our own minds that the catalyst was there for a structural uptick in uranium price, because our investment style doesn't work unless you've got an underlying rising commodity price in, over the next sort of 3 to 5 years at least. And I would say we're still sort of looking, but maybe with a bit more of an open mind. We don't yet have complete conviction, but we're becoming, maybe the best way to describe it is a little more open and positive in our receptivity to the uranium story. And I think part of it is going to be, will there be a consensus view that for effective solutions to climate change, that nuclear has to be part of the mix? We believe so. We've always believed so. And there are some green shoots of sort of leading influencer sort of opinions in support of this. Gates, for example, in his new book, and others make a very strong case that to get to as quickly as possible to sort of a zero carbon world, it's going to be really hard to do without nuclear power. And I think if we get to a point where that viewpoint is embraced and people start building nuclear power plants again, then, it's a game changer, obviously, for uranium. So it's moving in the right direction. Whether we get there or not, I think there are some really interesting new technologies on the nuclear side. I think in the US alone, there are something like 60 plus different startups and some that have been around 10 or 15 years, well-financed, that are developing new disruptive sort of solutions to get around the problem of, these massive capital blowouts when you try to go build nuclear power plants by having sort of small, portable, contained units where basically the power plant's built at the factory, maybe in containers, and each container is so many megawatts. And if you want 300 megawatts, you string 30 of them together, you bury them in the ground, and you sort of connect them in with a cable. I'm oversimplifying, but so you get around the problem you have now with nuclear, aside from the concerns about the risk, but more fundamentally, can anybody, at least in the OECD countries, build a nuclear power plant without a 5x capital blowout?
Mm-hmm. Excellent, Mike. As we conclude here, do you have any final thoughts you'd like to share with our audience?
No, I think it's going to be a good time for the next 2 or 3 years, I think, for those of us that focus on the metals industry. And I think that the battery metals in particular should outperform for all the reasons we've talked about. So if you can get exposure either through companies or physical metals or metal option calls on anything that has to do with copper or nickel, lithium and cobalt are a little bit more difficult to get exposure to, but copper and nickel are a little bit easier to play. I think you're going to be well rewarded because there's no question the demand for these metals is going up, and the capacity to deliver them is getting harder by the day. So that's kind of a good place to be. It means that prices should go up. And as prices go up, the companies that mine these sorts of metals should disproportionately benefit in terms of share price.
Mm-hmm. Excellent, Mike. Well, for our listeners that would like to know more about you, you're a hard guy to kind of do research on and get a hold of. But as you and I talked about, you've kind of engineered it that way. Mike, thanks very much for your time today. Really appreciate it.
Tom, always good chatting, and look forward to our next conversation. Thanks so much.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.